afternoon, ladies and gentlemen. Can you all please come and settle down? We're about to start our session. It is my great pleasure to introduce you to one of Silicon Valley's amazing venture capitalists who has a different mindset, a little bit of unconventional when you look at the kind of companies he picks and how he invests and how he mentors them. So he's none other than Ashmeet Sidana, and his fund is called Engineering Capital. And I've requested Ashmeet to come here and actually play with us on his the way VCs think, the way VCs articulate. So it's going to be a very interesting session because most of the time entrepreneurs don't think of reading the mindset of a VC. So it's a significant session, and so please, enjoy. And Ashmeet, please welcome again. Thanks again for doing this on short notice, and I pursued you, and thank you. And
thank you.
Welcome.
Thank you, Ram. It's a real pleasure and a privilege to be over here. If you could please put the slides up. I have a talk on that. This is an extract of a lecture, the series that I've developed called How to Think Like a VC. So you're going to get the whole thing in one short presentation. And I would like to start with a quick thought experiment. So here's how the experiment works. You have two choices, option A or option B. Option A, if you choose that, you get $1 guaranteed. It's very simple. Option B, I will toss a fair coin. It's a fair coin. There's no cheating, 50% heads, 50% tails. If it comes up heads, you get $0. If it comes up tails, you get $3. So there's a 50% chance of getting 0 and a 50% chance of getting $3. How many people would like to choose option A? Let's do a show of hands. Okay. I have no people choosing option A. Very interesting. Okay, how many people would like to choose option B? Let's make sure everyone's listening over here. So everyone over here wants to choose option B because it has obviously a higher payoff, right? You get more money. Statistically, there's a 50% chance that you could get that. I'm now going to change the experiment just a little bit. Okay, option A looks very similar. Only instead of $1, it's $1 billion guaranteed. Option B looks very similar, 50%, same coin, same probabilities, 0 if it's heads. How many people would like to choose option A? Okay, lots of people choosing option A this time. So clearly people are changing. How many people want to choose option B? Okay, we have a few people who are still choosing option B. I like that. So anyone who changed from A to B, you want to tell me why did you change your vote? Go ahead. Scale, because the numbers are bigger. Exactly. You've hit the nail on the head. So when the amounts change, it changes how you behave, even though mathematically they may be the same. Even though the mathematical analysis, the risk payoff, the expected value is identical, but because the number changed, your behavior changed over there. So human beings are not perfectly rational. Human beings have a utility curve. The utility curve changes. That's the theory behind it in terms of how people work. As you can see over here, option A is lower risk. So in that you get a guaranteed payoff. Option B has a higher reward. So there's no right or wrong answer. It really is a question of preference. We had some people who were choosing option B even in the second scenario, when the numbers were very large. Those are people who want to get the higher reward in return for higher risk. That's really what they're choosing over there. And so the first point that I wanted to make about how VCs think is that VCs are risk-seeking investors. In other words, we are looking for higher risk in return for higher reward, of course. If it's rationally speaking a higher reward, we would prefer a higher risk scenario. That is what VCs are doing. So you already know that VCs are now higher risk. The second part of this phrase is, we are investors. And so most of my talk today is really about thinking like an investor. Once you realize that you're seeking higher risk, then the question becomes, how do investors think? And the first question question which comes up when you start thinking like an investor is, what is the difference between investing and gambling? Because gambling or speculation seems very similar to investing. You put a little bit of money in. If you get lucky, you get a lot of money back. If you're unlucky, you don't get the money back. It feels like a very similar type of activity. Here are two actual real-world scenarios. In Las Vegas, if you walk in, you play roulette, you put it on some number. In this case, I happen to pick number 7. That's my favorite. You can pick some other number. You get 35-to-1 guaranteed odds paid. So that's what roulette pays in Las Vegas. You could make $35, but of course, there's a probability that you wouldn't. And since we are here in Santa Clara, I picked NVIDIA as the example. If you had bought NVIDIA stock a little while ago, you might have made 35 times on your investment on your NVIDIA stock. So what is the difference between these two? Anyone like to tell me what the difference is? Why is one called gambling and one called investing? Why is one so bad that the government tries to outlaw it, regulates it heavily? You can get counseling from psychologists on how to avoid doing it. And on the other side, it's so good that the government gives you a tax break if you invest in that. The government will educate you, give you tax-deductible education on how to make it happen. They seem very similar activities. What's the difference between these two? Go ahead.
In the first case, the one can go to zero immediately.
Yes?
In case the one may not go to zero because NVIDIA has inherent value.
It's a valid answer, but I would disagree because one can go to zero. When you are investing. There's nothing which says that when you invest in a company, the company can't fail. I can tell you that I have a lot of gray hair on my head, which have come from companies that actually went to zero as a VC. So I would say that's not the right answer in terms of what the difference is. Let's take one more in the back over here.
Safety. I think you're buying safety in one of the...
Safety is the answer that I'm hearing from the audience over here. I'm sorry, I don't know your name, but I would say safety is also not the answer because clearly over here, the payoffs are similar in terms of what they're doing. So in the interest of time, I'm going to just give you the definition of what is the difference between gambling and investing. This is the canonical definition. This is the business school definition of what the difference is. In gambling, the probabilities are known, the outcome is not known. In investing, the probability is unknown, the outcome is known. So they are mirror images of each other in terms of what is happening in the real world in front of you. And in fact, Peter Lynch, who was a great investor, he was the manager of the Contra Fund, worked for Fidelity, sort of a Warren Buffett-like figure in terms of what he does, what he did. He says an investment is a gamble, in other words, it feels like a gamble, in which you've managed to tilt the odds in your favor, in which you've managed to change the probability to be in your favor. Remember, in roulette, you can never change the probability. The probabilities are fixed. In fact, they are mandated by law in most places, certainly in Las Vegas, they are mandated by law. I don't know about how people do it in other countries or other locations. So when you are gambling, the probabilities are usually fixed, but they are certainly known to a very great degree of precision. When you are investing, the probabilities are unknown, and your job as an investor is to change that probability. That is what a great investor does. So then the question arises, how do you change the probability? If that is your job as an investor, how do you change those probabilities? In venture capital, there are many ways in you can do it. Now, certainly if you were an investor in bonds or an investor in public markets, there would be other ways in which you would change the probabilities. I'm going to talk about venture capital, and the rest of this talk is all only about venture capital. So it's that subset of investing that I'm talking about. The first way in which you could change the odds in venture capital is by getting access. Venture capital is a very inefficient market. Entrepreneurs start companies. They choose to talk to investors that they like, or they have heard of, or that they believe will be good for them. In other words, investors who have a brand. How many of you have heard of Andreessen Horowitz, Sequoia Capital, Benchmark Capital? These are firms that have a brand, right? Everybody's nodding their head over here. So these are investors who have invested in building a brand. Brands are not accidental. It takes time, money, and effort to build a brand. So these are investors who've built a brand. In return, what they get is access. So you are a great engineer at NVIDIA, at Google, at Facebook, at whatever. You wake up one day and say, I'm going to start a company. Who should I call? Well, you think of a brand. You think of a brand who you call. And someone who doesn't have a brand may not even get a call. So what happened? That person, that venture firm which had a brand, got access to a deal that someone else did not get access to, and so they have better odds. Statistically, if people call you more and if you see more deals, you will get a better outcome. So that's a very simple example of how a VC would tilt odds in their favor. Okay? Another way in which you could do it is by doing proprietary deals. You can incubate your own deals. Instead of waiting for someone from Cisco or Google to call you, you can call them up and say, hey, John, would you like to start a company? I think you'll be a great entrepreneur. I'll give you money if you start a company. And if you do it well, they might choose to take money from you. And now suddenly you've created access for yourself that even a great brand may not have. So what you're doing is you are systematically changing the probability. You are moving the odds in your favor of getting access to those deals. Similarly, valuation, you can pay up. There's nothing which stops you from paying a higher price than someone else. Remember, we have asymmetric payoff in venture capital. Just because I pay double for a deal, I may still be a great return on investment if I have chosen wisely and if I've picked the right deal. And there are firms which have followed this. Famously, Andreessen Horowitz, when they started out, were paying the highest price because they just wanted to get access to those deals. And they established a reputation for themselves as paying the highest price. That's a way in which you can get deals. They picked well. They've built a firm starting with that strategy. Terms, which is a variation of valuation. Similarly, you can work hard to increase the outcome. That's a whole other category of things you can do to change the probability. So I've made the investment. Investment is already done. The entrepreneur's already there, the idea's already there, the company's already there. Let's say I help them hire a great VP of sales. That company will do better because they have a great VP of sales. Now the outcome may be better. So simply by helping my own companies, and you will often see VCs thumping their chest and touting how much they've helped their companies, what they're really saying is, I'm trying to increase the outcome. You know, we are not in the charity business. We do that because it increases the outcome, increases the odds of what we are going to do. I'm not going to go through all of these. I mean, even PR can be a great strategy. I mention that because oftentimes people get confused by the PR. They get confused by why is someone saying this, why is someone investing so much effort over here. Mark Andreessen, I'm taking Andreessen Horowitz as an example again, invested very heavily on Twitter early on just to build his personal brand. Even today, a lot of VCs spend a lot of time building their personal brands for that very reason, because it helps their companies. That's what they're really trying to do. They're trying to increase the outcome over there. And then, of course, the last category is analysis. You can just do better analysis. If I'm better than you at looking at the same information and coming to a conclusion and deciding that it's going to be a better investment, I can increase the odds, I can have a better investment, I'll have a better track record. Here's the interesting thing about these characteristics. Most of these can be observed publicly. When somebody establishes a PR strategy, even valuation, you can figure those things out from the outside. You know, especially if you're in the business and you pay attention to it, and if you read, you know, your news and you stay current on what people are talking about, those things can be observed publicly. What cannot be observed publicly is the analysis. That's the secret. That's the magic. That's what happens behind the curtain. That's what happens on Monday morning in the partner meeting when people go thumbs up or thumbs down, which you are doing all the time as a VC, right? Every Monday, every partner in every VC firm is sitting there and deciding on, you know, 5, 10, 50 deals. They have to make a decision, are we going to move forward or not on that? Occasionally we get lucky. What happened over here is, everybody here is familiar with YouTube. YouTube was an investment that was made by Sequoia Capital. YouTube was acquired by Google. Viacom sued Google for copyright infringement. And that lawsuit, as a part of the discovery, some of the content from Sequoia Capital's internal discussions made prior to the investment in YouTube became public record. And so what I'm very happy to share with you is part of that public record, so you can peer behind the curtain and actually look at the analysis that went into making this decision. I emphasize that this is all public record. This is the timeline of when it happened, and Roloff Botha is the partner who was working on it. I have no affiliation with Sequoia Capital. I don't work with them. They don't owe anything to me. Everything here is public record, and in fact, you can go to the district court website in New York and download all these documents. So everything I'm sharing with you is now public record, but the critical thing is, it happened before the investment was made, when it was not obvious whether YouTube is a good investment or not. So that's what I'm going to share with you now. So let's get started. We are now going to do exactly what Sequoia was doing, 15 years ago when they were investing in YouTube. And by the way, we have it under oath from Roloff that is exactly what happened. So this is as good as it gets in terms of being able to sit in a partner meeting room and see the discussion of what is going on in a great investment. Obviously, it was a great investment. So the first thing I'm going to do is present to you the slides that were presented by YouTube to Sequoia, so you can level set. You have the same information that the partnership had before they were going to discuss what we are going to do to make this investment. This is the original seed presentation made by Chad to Sequoia, and these are the slides that were presented by him. So the name of the company is YouTube, and they have a tagline, broadcast yourself. Company purpose, to become the primary outlet of user-generated video content on the internet. Wow. What an amazing start to a presentation. This slide is still valid today. 20 years later, their purpose was so good, so crisp, so far-looking that it is still valid today. Isn't that amazing? That is called clarity of purpose, a great characteristic if you're going to look for a great investment. The problem? Video files are too large to email, video files are too large to host, there's no standardization, and videos exist as isolated files. 20 years later, that problem is still valid today. What an amazing problem these entrepreneurs picked. Isn't that amazing that they were able to do this? Amazing. Solution? Customers upload their videos, YouTube takes care of serving it. Wow. Other than the fact that they've replaced Flash technology by HTML5, this is still the solution of YouTube. This is a $20 billion per quarter business for Google today, right? Isn't that amazing? This is the seed presentation by YouTube to Sequoia Capital looking for $1 million of investment, the first money into the company. This is the seed deck that I am showing you. Market size, blah, 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 blah. Sorry to say, this is not really market size, but that's what the entrepreneurs called it. I don't believe this is a market size discussion. Competition? Wow. There's a lot of competition already. Guess what? Even Google is in the business already. It's not just some small little company, right? They haven't even raised their seed round yet at YouTube, and Google has a competing product already in the market. And guess what? Through the magic of the internet and the magic of leaks and the magic of lawsuits and reading emails late at night, which is what I like to do at 3 in the morning, I have for you the emails of what was happening inside Google when this presentation was being made. So not only do we have Sequoia's emails, we also have Google's discussions. So here are the actual emails inside Google discussing YouTube. Jeff Huber is the VP of Engineering, and he is saying, all this is public record, so I appreciate people taking photos, but you can actually find it all on the internet, so there's nothing secret about this, okay? Man, there's this little website that's cranking features pretty fast, and then, Peter Chain, who's the manager in charge, is responding like a good, engineering manager in a big company. We will have all their features in Q4. Just give me one more engineer. I just want to increase my headcount, right? If I had one more good engineer, we would be kicking butt. In fact, Nikhil is pitching in to help. This Nikhil guy better be damn good, because Peter is saying he's going to kick YouTube's butt over here. Classic big company response. Classic failure mode of why startups win against big companies. The manager wants more resources. The VP engineering is asking the manager, the person who has the most to lose, on an opinion about the decision. This is how bad decisions get made, folks. This is how bad decisions are made. This is why small companies can win against big companies, even when they have a product already in the market. This is why VCs exist. This is why startups exist. Guess what? There's more discussion over here. Eventually, it gets escalated all the way up to Larry Page. I'm not going to go through all of those, except to say, and I want to make sure I showed that. Oh, yeah. This is an important slide. On the top left, you can see they want to pay 10 to 15 million. They want to buy the company for 10 to 15 million. Remember, this is a pre-funding, pre-seed startup that has just popped up on the radar of Google. But Google is not a bad company, even though I was throwing them under the bus a few minutes ago. This gets escalated all the way up to Larry, and Larry Page is the CEO at this time, and Larry Page actually says, you know, I think we should look into buying them. His instincts are up. Something is wrong here, right? That is good CEO behavior. Okay, what he's saying is, you know, here's some potential competition. Let's buy them, let's kill them, because, you know, they want to maintain their monopoly, of course, at this point. Just in case you feel that Google is the only one making this mistake, here is a quote from Mark Cuban, so-called famous investor, who says only an idiot would buy YouTube at this point. Okay? So this is not a one-off occurrence. This happens all the time. Smart people, good people, rich people, well-connected people make these mistakes all the time. This is happening contemporaneously while YouTube is being pitched to Sequoia for a seed investment of $1 million. So let's go back to the deck. Product development slide. They're presenting in this deck. Frankly, I don't know what this slide is about, so I'm not going to waste time on it. I think it's kind of a throwaway slide. Sales and distribution. I mean, talk about a silly plan, right? Basically, they don't know what they're doing. What they're saying is they're going to try everything. They're going to try premium, they're going to try advertising, they're going to try charging members, they might even do enterprise. They really don't have any plan. This is the kitchen sink of answers. This is someone when they don't know the answer, when they put up as a slide. Team, wow. That is an amazing slide. My opinion, okay? They have distilled the essence of what makes a great entrepreneur. Why someone should give $1 million to these 3 young kids. And they have distilled the essence of who they are and why they should pick them. Steve starts on the very top of the slide, recruited by Max Levchin. How many resumes have you seen that start with recruited by XYZ as the first line of their resume? Isn't that amazing? Max Levchin used to work with Roloff at Sequoia. These guys know what they're doing. Saying that you were recruited, now today it's very easy. Everybody knows Max Levchin, famous guy, PayPal, Mafia, etc., etc. That time nobody knew that. But Roloff knew how good Max is, and to start your resume by saying that I was recruited, this person hired me, therefore I must be good. That's what he's trying to say. That's the message on this slide. Isn't that amazing in terms of what he's presenting? Okay, metrics. Wow, this is kind of a tough slide. Okay, there's a little bit of growth, and then it kind of looks like it flattened out in terms of the chart. You know, the last several months have been, weeks have been pretty flat. And then most importantly, it's still a very small number, 100,000. That's it. This is not millions of users. This is not an obvious thing that has already happened, which is, you know, it's going to be the next Facebook. There's only this very small number of users on this slide. And that is the last slide of that deck. So this is the deck. Classic problem, solution, opportunity presentation. That's the entire slide deck, by the way, okay? That is the entire set of information on which you have to make a decision on whether you're going to write $1 million check or not, okay? The other thing to note on this slide deck, really, really important, is that it follows the 10-20-30 format. That is a format that I personally love. If those of you are entrepreneurs in the audience, I urge you to think and read and understand why that is such a powerful format. Guy Kawasaki invented it. 10 slides, 20 minutes, 30-point font. If you cannot say it in a 30-point font on a slide, you don't know what you're saying. That's the basic essence of what you're doing. If you're making a pitch deck, do not reduce the font size, okay? Instead, reduce the number of words. distill the essence of what you're trying to say. It's hard to do. It takes a lot of effort. Notice that YouTube had done that. So that's just an aside on it. So now I'm going to analyze that deck from the lens of what I could glean from Sequoia's emails. I'm going to use my own framework because I, of course, don't have access to Sequoia's framework. I don't know how they analyze internally or how they mark them up. This is just a very standard business school format of how deals are evaluated. You know, team, market size, barriers to entry, financials, why now, and finally the deal. You know, what are you buying? Buy low, sell high. So this is just a standard format. I'm going to use this to analyze what happened with YouTube and why. The first thing, here's what we know about the deal. Notice it wasn't in the deck itself. There's some information here where everything in the dotted squares are extracts from emails from inside Sequoia. Everything in the solid squares or solid rectangles is public record. So that's the way the content is organized on this slide. And what they're proposing is a 1 million investment followed by 4 million with a pool of 17%, and they want to own approximately 30% of the company. That is the internal expectation of the deal that is being presented to the investment committee, to the partnership, in terms of what they're going to invest. However, there's a press release which says that there was a $3.5 million investment, so there's some inconsistency in terms of what the information is. 5 million for 30% is a post money of 17, 3.5 million is about 12, 42% difference in the two. I mean, 42% is a rounding error, guys, so let's forget it, okay? Who cares? It's just 42%. So I'm just going to ignore it. I'm going to say it was, 15-ish million at which the price was done, okay? Let's be generous. Let's call it 16 million at which the deal is done. 1 year later, the company sells for $1.6 billion. Google bids $1.6 billion 1 year later to buy the company. That is a return of 100x on your cash. That's a good venture deal. Almost a great venture deal, okay? That's a return of a 10,000% IRR. That's a really good IRR. If you're not familiar with IRRs, Einstein called it the eighth wonder of the world. It really is an amazing thing to understand compound interest and how powerful exponential curves are. That's not what this talk is about, so I'm not going to spend more time on it. I'm going to go back to analyzing the deck to say that Sequoia internally has a very interesting discussion on why now. Remember, there was a market size slide in their deck, which I respectfully submit is not a market size discussion at all. However, from that discussion, Roloff sends an email internally where he writes, XXXYYY, as a result, user-generated video content will explode. That is the billion-dollar line. That is the billion-dollar analysis. Remember, this is the year 2004, 2005. Smartphones are just taking off. Broadband is happening. That is what he's analyzing. Sequoia famously likes to invest in markets, not just entrepreneurs. They correctly analyzed that user-generated video content would explode. That is the magic of the investment in YouTube. That is the heart, I believe, of one of the things that they're doing. And internally, they had reached that conclusion by analyzing the information that YouTube was giving them to reach the conclusion that user-generated video content will explode. Financials, wow, TBD. There are no financials, remember, in the entire deck. In venture, it's not about the financials. 42% is a rounding error. If you need a calculator to calculate what you're doing, you're stuck in the weeds. You need to step back and think big and look at the forest, not at the trees, when you're looking and analyzing at a venture capital investment. All they're saying in there is that the company is currently serving 100,000 videos and it's costing them $4,000. That's all the analysis on the financials. There's no projection, there's no discounted cash flow analysis, there's no weighted average cost of capital, WACC for those of you who are financial people, or DCF for those of you who work in big companies which try to analyze this kind of stuff. And all they're saying is that there's a software abstraction layer, and that's why they do it. That is the financial discussion that occurs inside the partnership to make the investment. So when people talk about, oh, so-and-so will buy me an X% greater and Y% greater, that's not how venture investments are made. Venture investments are made on macro elements, large, massive changes that are occurring. User-generated video content will explode. That is the observation, that is the premise of the observation that Sequoia has made, on the basis of which they're doing this discussion. Barriers to entry, they have an extensive discussion on barriers to entry. Remember, this is a company which is a consumer website open to the public, where Google already has a competing product, okay, and there's a whole bunch of others, Vimeo and all the other guys who are running around over there. And it's a fairly obvious thing. There's no secret on how to serve a video on the internet. Everybody knows how to do it. In fact, there are standards. HTML5, MP4, MP2, all of these standards are there to serve all of these videos. Okay? All the way back, my first job, Silicon Graphics, I worked on the very first movie player for Silicon Graphics. Okay? So this is not something that is new or novel, but they are identifying the barriers to entry. They are identifying community, competition, velocity, technology, all of these as barriers to entry to why YouTube as a particular company will be so valuable. Here is an entire analysis of the cost of serving a video, and they have convinced themselves that YouTube has invented a structural advantage on how much it will cost them to serve a video, and therefore an advertising model is actually a valid solution when it was not valid for other people whose costs are higher. Now, of course, we know the end of the story. We know eventually Google bought them, so we know how powerful their technology was. But that was part of the magic of YouTube, which is what Sequoia is analyzing over here. And they're doing this analysis themselves, right? Market size, remember, there was no market size, according to me, in the deck. Sequoia internally has a very interesting market size analysis, because they, of course, have to estimate the market size before they make an investment in the company. They say, I believe YouTube has a clear advertising revenue opportunity. All those other business models they've ruled out, because YouTube has a structural advantage on the cost of serving, and therefore advertising, which is a very attractive model if you have the lowest cost, is a very attractive business model for you to follow. And then Roloff, presumably, creates his own spreadsheet to estimate himself what the market size would be. And this is his spreadsheet. Classic, low, medium, high. Okay, as you can see from these very beautiful round numbers, 10 million, 20 million, 30 million views, CPM of 10, 15, or 20. These are just estimates. They're just broad estimates. This is not based on any real-world data. This is just a broad estimate of roughly where things would fall out. Okay? And then there's an implied revenue. He convinces himself that YouTube will at least get 5 million in revenues and may get as much as 55 million in revenues. That's kind of roughly what he's trying to get a ballpark on. Again, it's orders of magnitude that matter. Within their own estimate, there's an order of magnitude that he is making in terms of what would be okay. And they get comfortable saying, yeah, there's going to be revenue here, and it's enough for this to be an interesting investment. In the good case, they may even make $50 million in revenue. Of course, he was vastly, vastly wrong, because the future potential was vastly, vastly larger than what he had estimated here. It is my belief, I have no proof of this, I have no knowledge of this from the internal side, but it is my belief this is the reason why they sold the company for 1.6 billion. In other words, they sold it cheap. They sold it for too less. Google, they should have asked for more, and Google would have paid more, because they had internally convinced themselves that maybe the market is worth 50 million. What if they had put 500 million on this slide? They would never have sold it for 1.6 billion. What if they had put 1 billion, 2 billion? They didn't have to get all the way to 20 or even 100 billion, which is where we are today. So these kinds of things happen in venture capital. This kind of mistake is fine. It's okay to make these mistakes in venture capital. It's not really a mistake. This is just an error of estimate in terms of how far off you can be and still be okay if you get the direction correct. The important thing is to get the direction correct. That's what you need to get right. Getting the numbers right or wrong, that's okay. That's par for the course. That's just how it works in terms of the real world. Team, I already made, I can't resist talking about how special that slide is in terms of, what they're talking about over there, to the point that when Roloff copies the resume into his own investment memo, he actually follows that same format. Now, he does list the university first. He writes UIUC, and then he says, recruited as one of PayPal's earliest engineers. Okay? So he's building credibility. He's talking about that. This is an amazing slide over there. The other aside to note over here, which is actually not very relevant for our analysis here, in terms of obviously them making the investment decision because of what happened later, but the original idea was that they were going to hire a CEO. The plan was that they were going to hire a CEO and bring in a CEO from outside. They had already discussed that with the team, and they had the team's buy-in before the investment was made. That's unusual. That doesn't usually happen in venture capital. Certainly in an age when VCs try to be founder-friendly and they don't want to be known as the big bad firm that's trying to fire the founder or anything like that. But here they had built that relationship, they had built the trust, and that expectation had already been built. That's highly unusual in the venture capital business. But then venture capital is the business of the unusual. It is doing those special, exceptional things in exceptional cases that results in exceptional outcomes. And that's what Sequoia is demonstrating over here. Absolutely marvelous to see that over here. So here's the conclusion. What did you not see in what we presented over here? Let's start with that. There is no DCF. So your MBA, your business school, your finance, there is no such thing. There's no inch-thick diligence binder, okay? There isn't those, pages and pages of interviews and pages of competitive analysis and pages of, discussion about technology and team and roadmap and budgeting and financials and none of that PE stuff, which is what PE lives on, because they're trying to eke out 1% here and 1% there. Totally different mindset. That's not how venture capital is done. The way venture capital is done is on these thin memos with a small amount of information where what you are really trying to discern is the direction correct, which is usually a very faint signal in a lot of noise. There's a tremendous amount of noise out there. You have to be willing to say that user-generated video content is going to explode before it explodes. And if you get it right, then you can make a great investment. Okay? There are no consultants or analyst reports. This is a really important point. Good VCs do the work themselves. That is why they are VCs. If a consultant could do it, then you should hire the consultant and make him a partner. We get paid millions of dollars to do our work. You need to do the work yourself. Great VCs tend to do the work themselves. There's no Gartner report, Forrester report. If it is already in a Gartner report, it's too late to make a VC investment. Okay? And if there is a Gartner person who's writing a report which is that good, then hire them and make them your partner. You're going to make money off them if they're that good in terms of what they're able to analyze. Okay? And then finally, there are no bankers. These are not deals. These are not transactions. These are relationships. These are built the hard way for the long term. And that is why you are seeing this type of analysis when Sequoia is doing it. But what did we see? I told you what we didn't see, yet what did we see? We saw a great team. We saw a large market. We saw solid barriers to entry and very compelling financials. There was a real business model and a real financial advantage that existed in YouTube even when it was a free company, which you may perceive it today as a free company because they're still advertising based primarily. And that all had been figured out before even the seed investment was made. That's why it's a great investment. So bottom line, high risk but thoughtful investment is not a gamble. What Sequoia had done had tilted the odds in their favor by getting the access, but also getting the analysis done and doing that correctly. That's my presentation. Couple of caveats, and I'll open it up for questions over here. I am not a lawyer. Everything I presented today was been read from legal, deposition type of debriefs. I'm an engineer, I'm a venture capitalist, so just keep that in mind. And then finally, for myself, Ram was very kind. He mentioned that I practice a particular type of venture capital, a subset of the work that a big firm may do. I focus on companies where there are technical insights, where the technical risk is higher than the market risk. Remember, in the case of YouTube, the market risk was higher than the technical risk. Okay? So that's how the investment decision was being made. There's no right or wrong over here, one versus the other. There's all valid ways of making investments. I happen to have chosen this path. That's my definition of technical insights. And I tend to be a very early stage investor. Here are some examples of some of my investments. As you can see, I partner with all the other big firms. I only do seed stage investments. So I am the first investor very, very early in all of these companies. These are just some examples of my companies. And with that, I want to thank you for being such good listeners. If we have time, I'll take some questions. You're standing over here, and we're out of time. Okay, I'm sorry we're out of time, so thank you very much. Thank you.